Good morning and welcome to this Wednesday, February 9th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got some pretty strong futures this morning, so that's, I would say, a pretty good thing if you're on the bullish side and hoping things can reverse and get out of this nasty downtrend that we've been in. Well, we are at least seeing some nice action this morning. Dow futures currently are up about 250 points. S&P 500 futures 43, which is almost up 1%. Nasdaq futures up close to 200 points. So on a percentage basis, actually even higher, up about 1.25%. So it does look like we'll get off to a good start. We're having a nice little rally. Well, we had a nice rally. We pulled back, went below the moving averages, the key moving average anyway, the 20-day. And now we're going to try and go back up above it here at the open. The timing is interesting because tomorrow morning we will be getting a huge inflationary report. That will be the CPI. So we'll get the CPI, Consumer Price Index, along with the core number. And that is one of the things that has been driving, as that moves higher and higher, that's what's been driving growth stocks down, which in turn has been taking the market down. Value stocks doing much better on a relative basis. So we've got probably more bad news tomorrow morning. And the question is, have we seen enough selling to account for the bad news that we're going to get tomorrow? And I don't have the answer for you. I wish I did. But it's going to be very interesting to see not what the market does at 9:30, when we open, but what we're doing at 4 o'clock when we close. Because everyone's got to make their bets ahead of that 8:30 report tomorrow morning on the CPI. So anyway, that's going to be something that we've got to consider throughout the day. Take a look at how the market is trading. One thing I'll particularly be watching are those growth versus value ratios throughout the day, and especially in the afternoon as we get closer to the close. Are folks going into those growth stocks? I shouldn't say folks, is Wall Street going into those growth stocks before that report tomorrow? I would not think that would be the case, but hey, sometimes the market kind of does its own thing and we just kind of have to go along with it. Let's see, let's go over first. Let me take you over to earnings beats. Bear with me 1 second, just trying to get my screen set up. Okay, so if you are over at Earnings Beats, couple things I want to go over. We have a big event coming up on Saturday, and depending on how the action, well, even if the action goes up or down, really doesn't matter in the bigger picture, I think. But we've got a big event coming up on Saturday. If you click here from our homepage on this February educational series, you'll be able to learn a little bit more. But on Saturday, and you can kind of navigate down here. Right here, session 2. We've got this the anatomy of a cyclical. And by the way, I'm having a little bit of internet problems, so I hope everyone isn't having any problems hearing me on the other end. But Saturday we're going to do the anatomy of a cyclical bear market. I've talked a lot about what I think is the potential for a cyclical bear market. We almost reached it on that first leg down on the Nasdaq. We got close. And we've seen it in certain areas of the market. But, if I'm right about the way I'm seeing things, we're not done. We're going to have some more issues. And so on Saturday, I'm going to talk about prior cyclical bear markets that have occurred in secular bull markets. Secular, if you're not familiar with the term, secular bull market means long-term bull market. Like since the 2009 bottom, we've pretty much been going higher. Since 2013, that's when we took out the highs from 2000 and 2007 on the S&P 500. So I kind of look at that as when the bull market started, the secular bull market. But what it is it's a long-term bull market that will last for up to a couple of decades. And yes, you will have these periods along the way. In 2018, the trade war, fourth quarter of 2018, we had a cyclical bear market, a short-term bear market. We went down 20% in 3 months, but then we came right back, snapped right back to the upside after that. In March of 2020 with the pandemic, we lost 35% in 4 weeks. That was a cyclical bear market. Actually, I would call it more of a healthcare crisis. I'm not even sure really it was a cyclical bear market. But anyway, based on the definition, the 20% drop, it was a bear market. But to me, it was short term rather than long term. So that's cyclical versus secular. So I believe we're in a secular bull market, and we have these cyclical bear markets from time to time. We had them back in the 1980s, 1990s. We had them back in the 1950s, 1960s, while we were in secular bull markets. So the question is, what should we be looking at? What should we be expecting from a cyclical bear market if this truly turns out to be one? And I think it's going to be, even if we have a really strong day today, and even if we ignore tomorrow, I still think we're going to have rising inflation, rising interest rates, and no longer an accommodative Fed. We're going to have a much more hawkish Fed. And those things just normally don't coincide with a runaway bull market and breaking out to new highs. So I just don't see it happening for now. And maybe that's why it'll happen, because it makes no sense. But I think history is on my side. And anyway, we're going to talk more about history on Saturday, the 12th. So if you're not already a member at Earnings Beats, this is a great time to just do our 30-day trial. It'll get you into this event, and then also the most overlooked growth stocks event, which is the following Saturday. So the next 2 Saturdays, 2 good events, the 12th and 19th, both starting at 10 a.m., both being recorded, by the way. So if you can't make it live to the event, don't worry, we'll send you the recording. You can review that at your leisure. So it doesn't have to disrupt your weekend. I love this stuff, so I don't mind doing it. I enjoy going back, studying history, presenting it, hopefully learning. Hopefully we all learn something from periods of time in history when things just weren't very good. Because if we do have that facing us, we need to be prepared for it. We need to recognize what it is as it's occurring. We need to have the patience. If you're, really like to trade mostly on the long side, you may have to have a lot of patience. We're going to talk about all that on Saturday. So hopefully you can make it. Let's see, let's move on. Actually, before we move on, let's go back to the home page. If you want to learn more about Earnings Beats and just what we're all about, subscribe to our free Earnings Beats Digest newsletter. This is what I refer to as our community, in addition, obviously, to our paying membership. The EB Digest community is a group that we reach out to very often. While we have a lot of paid events where only members are invited, we do have a lot of free events, and we reach out to our entire EB Digest community for those events and send out room instructions so you can come in. And so you really need to be on this list in order to know about and to attend any of our free sessions. All it takes is a name, email address, no credit card required. You can unsubscribe at any time. We'd love to have you. It's a 3 times a week newsletter, Monday, Wednesday, Friday, a very, very simple, easy read. 2 paragraphs in a chart usually. Comes out maybe an hour or so before the market opens. But check that out. Sign up today if you haven't already. Name, email address is all it takes. All right, let's talk a little bit about what happened yesterday. The Dow Jones Industrial finished up 1%, a little over 1%, 371 points. S&P 500 up about 38, so up about 0.8%. Nasdaq strong, up 179 points, 1.25%. Mid caps up 1.9%, small caps 1.8%. So it was a good day all around. I mean, I can't really complain about, what happened. And if there's one positive that I see on this chart or on these charts, looking at these charts, it's probably the S&P 500's AD line. You can see we're still way below the prior high, but the AD line's stubbornly remaining pretty high. So, we talk about the market in terms of being a puzzle and putting all the puzzle pieces together. Well, if you're trying to put a bullish puzzle together, this would be one of the pieces that I would be, putting out there. Now, I don't think you're going to have a full 1,000-piece puzzle, because I think there's a lot of them missing that are more on the bearish side. So it's going to be hard to paint a completely bullish picture. But that's one thing that tells me that down the road, this is not going to be a problem. There's really no other reason why the AD lines would remain as strong as they are. Even the Nasdaq, which has seen this huge drop below all these prior price lows, The AD line hasn't gone back down below those lows. I think where we're still seeing true weakness is in the mid caps and small caps. And you can see that being confirmed with lower and lower AD readings. So I don't see as much accumulation taking place there, but I do see it in some of the larger cap names, and especially in these major indices. All right, from a sector perspective, materials, well, that was the best performing group on Tuesday, and you can see up 1.5%, a little bit more than 1.5%. We're trending down below the 20-day. Still a lot of work to do here, but hey, with the futures up this morning, maybe we can get back through the 20-day there. Discretionary stocks, nice rally yesterday. We finished up just beneath the 20-day. Unless things really reverse here in the next 20 minutes, it looks like we are going to probably have a big gap up. And I would expect that discretionary is going to gap above that 20-day moving average, maybe to test this 190 area, which was the prior low. So this is going to be the question today. And it's going to be a very interesting day. If you're somebody who really doesn't follow the market that closely, today's going to be an interesting day because we're making some key technical breakouts one day ahead of a key economic report. And will Wall Street, will the big money use this strength and these gap ups to exit at the end of the day? In other words, how do some of the ratios, and if you are a member of Earnings Beat, I follow some ratios pretty closely, especially the XLY versus the XLP, which is consumer discretionary versus consumer staples. If you really want a sustainable move, if you're making some sort of a breakout on the S&P 500, you really want to do it with discretionary outperforming staples. You want that ratio to go higher. It has not been going higher. In fact, it's been going lower. And even when we've had some rallies on the S&P 500, the ratio has left some question marks. Let me just, put it mildly. There are definitely question marks. So today with this gap up, is this any different than what we've been seeing? Do we get the breakout and do we have a trend day where we gap up? We just keep going higher all day long and aggressive stocks lead the defensive stocks. Personally, I'd be shocked if that happened right before the CPI report comes out tomorrow, knowing that number is probably going to be pretty strong. But I've seen crazier things in the market. So I'll be watching kind of the intraday action. Like I said, for me, I think this market's crazy volatile. Even with the rally we've seen, the VIX still remains stubbornly up in the low 20s. When the VIX was at 39, I remember talking about the VIX on my shows and talking about how we needed a rally to get that VIX back down maybe to around 20. Well, we've seen it. And whether or not, that support level holds or not, or whether we reverse off of that, that remains to be seen. But, once you get the VIX to 39, and that accompanied the S&P 500 down here, when you get the VIX up that high, you should not be thinking about shorting at that point. Because when the VIX gets up like that, what I expect is what I call a rubber band snapback rally. And that's because everybody has thrown the kitchen sink in when the VIX is near 40. And so usually you'll get that snapback rally, which is what we did. Took a little while. I mean, for 3 or 4 days, we didn't do much of anything. I think a lot of folks just kept selling, while Wall Street was saying, okay, keep selling, we'll keep buying. And then eventually when all the sellers got exhausted, we made this rally back up. And that's where we are right now, kind of in this stage. Move up, testing the moving averages. Are we going to roll back over again? Today could provide us the key. One last thing I'll say about today. It is the 9th of the month. There are the 2 worst days of the calendar month since 1950. The 19th is the worst. The 9th is the second worst. So today's the 9th. We're seeing some really good futures. Will this hold up today? I mean, if I was, wanting to short and let's just say, pretty aggressive trader, I think the opening gap today, I would have to give it some strong consideration with maybe, looking at key levels, maybe a breakout above the 50-day moving average, something like that being your line in the sand where you just say, hey, I'm going to sit it, I'll take my loss at that point, move back to the sidelines. One thing that could happen is we could see sideways movement at some point down the road Maybe the Fed comes out and raises by 50 basis points instead of 25. Maybe that is what really spooks the market and we get a big downturn. Whether or not we just turn lower here or whether we go sideways for a while, I think either one is possible. I do believe the odds are greater that we have not seen the low in this move to the downside, though, overall. So I know that maybe doesn't help a whole lot, but at the same time, the market's crazy. I mean, I don't know. It should go to see a therapist. It is crazy when the VIX gets up above 20, in the 20s and 30s. One day you got a huge move down. Next day you got futures up 1.5%. Then you're rallying in the morning, and then you have the big sell-off again the next, that afternoon. Then you gap down, then you rally back. I mean, it's just crazy. And it really is like putting your money on a roulette wheel in the short term. Longer term, I think we go lower. Medium term, midterm, intermediate term. I'm talking, over the next 3 to 6 months. I'll be very surprised if we don't take out the low that we saw in January. Anyway, a lot of time spent on that, but let's move on. I want to take a look at the 10-year Treasury yield. This morning, it is pulling back, or was. Let's see if it still is. Yeah, it's down a couple basis points. Yesterday, we got up to 1.97%. And if you haven't been paying attention, 1.97%, that was the high before the pandemic. So we were already trending lower. We had a move up in the fourth quarter of 2019. We hit 197 and then went into 2020, moving lower. Pandemic hits. We fall all the way down to 0.4%. And we have made this steady march for 23 months. And yesterday, we finally got all the way back to that high. Now, this also will hold some clues for stocks, because I believe if we break above the 197 level, which could happen tomorrow, depending on how the markets react to that CPI report. I mean, it's expected to come in at 0.5% for January. That's already going to take the annual rate up, because the month that it's replacing, January 2022, is replacing January 2021. That was a flat month. So if this just meets consensus, rises 0.5%, the annual rate's going to go up by 0.5%. Now, what happens if we come in at 0.7%, higher than expected? That's the situation where I could see us breaking above that 197, maybe opening over 2%. Will that spook the market? I mean, your guess is as good as mine. We'll see. I would be very cautious. I think it's something that certainly could spook the market. We've seen it before. But anyway, that's one side of it. Now, the bullish argument is, okay, we hit resistance. We're likely to back off. And what if the CPI report tomorrow comes in 0.4 instead of 0.5, a little less? Annual rate still goes up, but at least in the short term, maybe that's a little bit of a kick save. And maybe the yield pulls back, and that allows the rally in stocks to continue. I mean, obviously, there's two sides to this. I believe we go lower. That is what, I just think that the market wants to go lower. But short term, I think between today and tomorrow, we're probably going to get our clues as to whether or not this rally, this rubber band snapback rally that we've had off of the January low, we're going to find out if we have any more legs. I think between the, this gap up today and whether or not we can sustain it, and then tomorrow morning's CPI report, I think that's going to tell us a lot. All right, so what's going on with the S&P 500? Let's talk about this for a minute. So I've been watching the 50-day, which has been coming down now at 46.13. Also, the recent high. So this was the rally. We got up to a close of 45.89. We had a high of 45.95, up close to 4,600, and then that 50-day sitting at 46.13. Now, right now, we closed yesterday at 45.21, and I am looking at, well, this is a little bit in 10-minute delay. So let's pull up the spider and just see where the spider is. Oh, forgot to hit that symbol summary. By the way, it's stock charts, if you're not familiar, if you pull up the symbol summary, not the sharp chart, but the symbol summary, which is right above it, and then type in a symbol in pre-market, you'll get pre-market prices. It's been around for a while. Most of you probably know that, but anyway, just want to let you know. All right, so right now, the spider is up roughly 0.9%. So in S&P 500 points, that would be roughly about 40 points. So let's go back to this chart. So 40 points from where we closed yesterday takes us to 45.61. Now remember the recent high, 45.89 on the close, 45.95 intraday, and the 50 days 46.13. We're going to probably open somewhere close to within about 1% of this combination of this overhead resistance. So after we gap up, I think the S&P 500 still has potentially another 1% or so. And what I've seen in the market historically many times is when you get the snapback rally and you pull back, I mean, yes, that 20-day moving average is certainly resistance, but so is the recent high. So what we could do is simply go back up, test that recent high, and then another move to the downside is very possible. But again, for those of you who want to remain more bullish, more optimistic, what you want to see is between now and tomorrow, moving through that 50-day moving average, getting through it, and then starting to make this look more like, instead of a head and shoulder top, more like sideways consolidation. Because if we can get through the 50-day, I mean, that honestly opens the door to go back to the highs, or maybe a left shoulder neckline, head, right side of the neckline, which would be very close to the all-time high, 47.50 or so, and then come back down for a right shoulder. That would be a bullish pattern. I mean, I'm bearish, but I'm going to try to remain pretty objective here and watch. And if the market starts to do things I'm not expecting, I don't mind changing. I'll be a chameleon, change colors if I have to. Market conditions are continually changing, and as technicians, we have to change with them. But I would still be careful. I would be very careful at this point until the market can show us a little bit more. All right, let's take a look. Let's take a look at the Nasdaq real quick. So the Nasdaq gapped up above its 20-day, barely closed above it, and came back down. It has to the top of this candle body, which was the open, let's just call it 14.5. And we closed yesterday at 14.1. Let's call that 14.2. So roughly 300 points to get us back to that high, which off of 14,002 is going to be a little bit more than 2%. So the Nasdaq has to rise about 2% to get us back to that 14.5 level. This morning, oops, let's pull this chart up. So this morning it's up 1.26%. So we're still going to have about another 0.75%. So if we can open up 1.25%, that would be 140 plus, what is that, 3,500? That'd be 175 points roughly, which would take us up to about 14,369, 14,370. So it's going to take us up in here somewhere, which will leave us about another 1% to the upside to get to that 14.5, maybe just a little under it. Very similar to the S&P 500. So those are just, I'm throwing some numbers out maybe to keep an eye on throughout the day. The closer we get to these recent highs, and especially if you see an intraday move go through these highs, and then we come back down in the last 30 minutes and close below, in my opinion, I know it's a big gamble because we've got a big report coming out tomorrow morning on inflation, but you've got a much better reward to risk shorting at this level than you did down here at this level when the VIX was through the roof. When I talked about having patience to short, waiting and allowing the market to come back up and kind of gather itself, if you believe we're going lower, well, we've gathered ourselves and we got a big report coming up. So I, normally don't like to short within a secular bull market, but I have no problems taking smaller risks. And so something like, the SH, which tracks the S&P 500 on the inverse side. So if the S&P 500 goes down 5%, the SH will make 5%. This is something that in a retirement, you can't short in your retirement account, but you can buy the SH, which in effect is shorting. So I don't really understand why you can't short in a retirement when you can buy investments that short for you. But anyway, that's a topic for another day. That's just a very simple dollar for dollar. So, or point for point, percentage point for percentage point. So if the S&P goes up 1%, you're going to lose 1% in the SH. Now, if you wanted to get riskier, you could buy the SDS. And the SDS also moves inverse the S&P 500, but it moves inverse double. So sometimes when I'm trading, like if I wanted to trade and I just wanted to be all in on the short side, sometimes in a retirement account, what I would do is use the SDS instead of the SH. And the reason I would do that is with the SDS, you can trade half of your account or whatever percentage you want to do. But if you wanted to trade your whole account on the short side, you could do half of it with the SDS, which effectively is shorting your whole account. But the benefit of doing that is if you sell, but then in another day you want to get back in again, you could get back into the SDS with the other half of your account. So you don't have to worry about using unsettled funds. So sometimes the SDS is better than the SH, or the QID for the Nasdaq. That's the double inverse. Those are the things that I would consider. Individual stocks, these growth stocks have been beaten down so badly. I mean, if you pick the wrong one to short and these stocks go up, you're not going to lose a couple percent. You're probably going to lose 10, 15%. Look at ENPH. Let's move on and talk about earnings for a second. So let's pull up ENPH, which reported last night. This is in phase. You see the stock been down. Okay, it's getting back up there. Let's go ahead and short that, right? Well, you better pay attention to when earnings come out, because look at Enphase this morning after reporting earnings yesterday. It's up $34, 23%. Now, if you go back to this chart, I'll point out a couple things. Number one, obviously it'll be very painful to short this stock right now heading into earnings. It's gonna gap up near its 50-day moving average. That's how quickly some of these stocks can start to recover. And it's why I believe in time. I don't think it's now, but hey, who knows? Maybe it is now. But I believe in time, growth stocks will do very well. I really do. I think they're coming back. The question is, do they go lower before they come back? Well, Enphase getting a nice pop here before the market opens. The other thing that I'll mention about Enphase is look at the relative strength of Enphase versus the renewable energy group. Now, renewable energy has been very, very weak relative to the S&P 500. And so that's created a lot of problems for Enphase, which has been going down relative to the S&P. But Enphase is much higher and much closer to its 52-week relative high than it is its 52-week relative low. In other words, yeah, the market's going down, or that area of the market's going down, but Enphase has been doing better than many others in its space. They came out with great numbers, and now we see why Wall Street has been favoring them over their peers. This was on our upcoming earnings relative strength chart list. It actually was one of the highest stocks in that list. If you opened it at the beginning of the week when we sent it out and you look at it like over the last month, the relative strength, I think Enphase was top 10 or 15 out of 332 companies in terms of its relative strength versus its peers. So I'm not at all surprised that we got the gap up with Enphase. It would have been a tremendous risk to hold it into its earnings, but I could have seen that one up to the 50-day. Also could have seen it back down to 120 or 115. So that's just a risk you have to be willing to take to hold into earnings. Let's see. There were a couple, maybe take a look at one or two other earnings. Chipotle came out. They're up pretty nicely this morning. This stock had been going down and reached a key support level all the way down here at 1,300, bounced back to the 20. And I think last time I looked, this one was up like $100. Let me go over here and use this chart. CMG. Yeah, 114 pre-market. So another really strong report and reaction there. Actually, I'll just show you on this chart. Let's look at a couple of others real quick. Lyft reported. They just matched estimates, stock down 2.3%. NEWR, this is one that I was actually very interested in, and which is one reason why I don't like taking the risk holding into earnings, because New Relic actually had performed better than most software stocks, and they missed their earnings estimate. And it's probably one of those situations where Wall Street went out and talked to them. And I'm not saying they were deceiving Wall Street, but they probably didn't tell them everything. And so when that happens and Wall Street gets hit like this, they take losses because they've been moving into the stock on a relative basis. This is not forgiven very easily. So you might look at this and say, well, New Relic's been a great performer. This is a great chance to jump in. And in the near term, it might be, because big gap down means market makers probably are on the long side. So maybe in the near term, we get a, maybe $5-10 back to the upside. But I think further down the road, this is going to be a problem for a New Relic. Let's do one from this morning. Toyota Motors. Toyota Motors and I think Honda both reported. Toyota Motors up 1%. Honda up. No, I thought it was up. Oh, it's gapped up. Market just opened. I'll try to make this really quick on the three you must see. Honda up 1.78%. So things look looking pretty good for those two automakers. Let's go take a look at the three you must see. I'm going to do these pretty quick. So I'm going to start. Let's go over to a relative chart. But I'm going to start with Expedia. Expedia broke out yesterday, and this was a stock that I had been talking about a couple of times on the air. I know it was an Earnings Beats Digest article maybe a couple of weeks ago, but I kept talking about this area right here at 190. We needed to break above it. We did it yesterday, and look at the volume come in. So we got that breakout. Now it's going higher. Any pullback back to 190 would be a buy, a second entry, rising 20-day moving average. I think Expedia looks really good right here. Amgen, they reported they had a huge gap up and a breakout above the recent high. So I would definitely be looking at Amgen as an uptrending stock. Last one, I was questioning whether or not AXP in yesterday's Trading Places Live over at Stock Charts, questioning whether or not we were going to be able to move through this high. Personally, as a trader, I would have sold it before yesterday. Anything up in the upper 180s, I would have sold as we hit resistance. And then I would be happy to get back in later if we make the breakout. But a lot of times we don't get through, and then you turn around, you come back down. I don't like to ride it back down as a short-term trader. So I'll be honest, I would have exited it $5-7 ago, $8 ago. But it did make the breakout. And so now I look at this stock much more differently. I look at it much more bullishly. And now any pullback down to the upper 180s would be an entry, along with the rising 20-day moving average. Those are your three you must see. And let's take a quick look now at the market, see what is going on here in the first 2 minutes. I know we got the gap ups. Are we going to continue throughout the day? We're going to find out. Nasdaq up little over 1%. It was 1.3%, so it's come down a little bit. S&P up around 1%. Dow close to 0.75%. Small caps, mid caps performing pretty well today so far. And there's that VIX still stubbornly above 20. We're still in a highly volatile market, so be careful. I would just say if you're trading, personally for me, I would do it with smaller position size. I just wouldn't, if the market moves against me and I get in on the wrong side at the wrong time, and that could be on either side. I'm telling you, we could get a breakout in the market, you just take off, and I think in my mind, more likely, but still either could happen. I think we could see this gap up and selling, especially later this afternoon as we get closer and closer to that CPI report tomorrow morning. Anyway, that's it for me. We'll see what happens. Let's follow the action. It'll be an interesting day for sure. Everybody have a great day. Happy trading.